Principles of Finance with Excel Modeling, copyright Lou Gaddis, Topic 5, WACC, Capital Budgeting, Enterprise Value, and Equity Valuation. In this topic, we're going to calculate the NPV using free cash flows to the firm and WACC, and estimate fundamental enterprise value and equity value using free cash flows to the firm and WACC. So continuing from last topic, we learned that WACC is a firm's cost of capital. It accounts for both the debt and equity providers' required return. And that cost of capital, cost of financing, is a candidate to use for when doing capital budgeting. In other words, you're calculating an NPV or an IRR. You could use that WACC as a discount rate to apply to the project. However, under certain circumstances, that's true. That is, if the current project you're looking to finance or to evaluate has the same business risk and capital structure, in other words, financial risk, as the existing firm. So, for example, Walmart is considering opening a second superstore in State College, Pennsylvania. The new venture's capital and tax structure are expected to be identical to its current business. So this new project, which is going to cost a lot of money, is going to be financed by the corporation. That new business is going to have the same risk as all the other stores and have the same capital structure as the other stores. In that case, just use the WACC to calculate the NPV, or use the WACC as the hurdle rate for IRR. However, if they're going to launch a new store, but now they're going to have a shift in policy, they're going to have a new capital structure. In that case, you can't use the current WACC because the current WACC reflects both the business risk and financial risk of the existing firm. This new project is going to have the same business risk. However, it's going to be financed differently, so it'll have financing risk, different financing risk. So what I would do is I would take my unlevered beta, in other words, the risk of that business without any debt, and I'll re-lever it based on this new project's, new investments, DDE and tax rate. I'll then calculate the cost of equity and use that in my WACC. In addition, if you're going to use, say, more debt in financing of this new project, there may also be an impact on the cost of debt. So you might have a new estimate of what the cost of debt would be based on the creditworthiness of this new enterprise. So the idea is risk is separated into business risk and financial risk. Business risk is captured by the unlevered beta. Financial risk is captured by the debt to equity ratio and tax rate to get the levered beta. Now, another example is, what if Walmart is launching full-service retail banks in every one of its stores? Now, you would presume that this risk is different than the normal risk of Walmart. So by using Walmart's WACC, even if it had the same capital structure, it wouldn't reflect the risk of banks. So what I would do in this situation is, if I were Walmart, I would get an unlevered retail banking beta. That captures business risk of banks. I would then lever it using the expected DDE and tax rate. Estimate the cost of debt of this new venture, and then I'd calculate the WACC and calculate the present value. Now, it's important to note, when you're using the WACC, again, the concept of WACC is the weighted average cost of capital. It's the rate demanded or required by both debt and equity capital providers. Therefore, the cash flows have to be cash flows that are available to both debt and equity holders. So what we want to use is something called free cash flows to the firm, which are the firm's free cash flows available to pay debt and equity holders. In other words, make sure you haven't subtracted any dividend payments or interest payments. An alternative would be to estimate equity cash flows. So I could subtract out the impact of debt and interest payments, and then that would be the cash flows available to pay equity holders only. However, in that case, I would only discount that project using an NPV using the CAPM discount rate, which is the cost of equity. And talking about calculating a free cash flows to the firm. Again, free cash flows to the firm are the cash flows you want to apply to the WACC. And the calculation, you can do it one of two ways. It basically depends on where you start. So if you start at earnings after tax, which already has interest subtracted, that's also called net income. So if you start with earnings after tax, what I want to do is then add back after-tax interest expense. So let's add it back. Therefore, that cash flow is available to pay both debt and equity holders. And then I'll add depreciation, because that's not a real expense. To get to cash flow, I need to go from earnings, add back depreciation. I'll subtract any changes in working capital, and non-cash working capital, and I'll subtract out capital expenditures, which may be listed in a financial report as changes to fixed assets at cost. Now, the second way to calculate it is if I start with the earnings before interest and tax. I am now starting at a base that has no interest expense. I then subtract out tax. Now, that would sometimes be called earnings before interest, but after tax. Then I don't have to worry about adding back interest expense. I can just add back my depreciation, subtract working capital, and subtract capital expenditures. So let's look at this example of Walmart launching banks. So I'm going to grab that data, and I want to put it into Excel. So it's going to cost me $8 billion today. So I'll put that cash flow in. Now I need to calculate the free cash flows to the firm for the next 3 years. These are estimates for the next year. So we're going to start out with earnings for interest and tax times 1 minus the tax rate. That's going to be earnings after tax but before interest. I'm going to add back depreciation. I'm going to subtract additions to CapEx. And I'm going to subtract changes in working capital. So I have $700 million or $0.7 billion in free cash flows to the firm. And then this model says that that cash flow is going to grow by 8% in the first year, or from year 1 to 2, and then grow by 5%. Then it's going to grow at 1% forever. So I'll just stop it there. Now I can calculate the present value of these cash flows, but to do that I need a discount rate. Now we're going to use WACC since these are free cash flows to the firm. Now this new project is going to have a DDE ratio of 0.3, tax rates 35%, cost of debt 4%. So the first thing I'm going to do, I'll start down here. Let me actually get, and also we determined that the unlevered banking beta is 0.4. So the first thing I'm going to do is calculate cost of equity. The business risk of banking is captured in the unlevered bank beta. I'm then going to add on the financial risk of that by adding the after-tax DDE ratio. So my unlevered beta times 1 plus the after-tax DDE ratio. So that business banking with this particular DDE ratio and tax rate would have a 0.478 beta. I can then calculate the CAPM discount rate for equity, risk-free rate plus beta times market risk premium. So there's my cost of equity. Now to calculate WACC, I'm going to need the debt and equity percents, not just a DDE ratio. So let's talk about converting a DDE to a debt percent. Now remember, debt percent is equal to debt plus, or debt divided by D plus E. So if you have a ratio of debt to equity of 0.3 to 1, so you can think about that as a ratio of 0.3 debt over 1 equity. You can rewrite the debt to equity ratio to calculate the debt percent as basically being the DDE ratio over 1 plus the DDE ratio. So if you have a DDE ratio of 0.3 for every $1 of equity, that means you have 0.3 of debt for every $1.3 of debt and equity, which is 23%. 1 minus that is my equity percent. So now I can calculate my WACC. Equity percent times cost of equity plus debt percent times cost of debt times 1 minus the tax rate. So I have a WACC of 434. I can then use that to discount my cash flows. First cash flow over 1 plus the WACC. I'm going to anchor that. Raised to the period power. Now I'll copy that for the next few years. So here's the present value of 8, 70, 76, and 79. Now the problem with this, if I just sum this up, this is going to pretend that the project ends after the 3rd year. But that's not the assumption we're making. We're making the assumption that this is going to continue infinitely. And in fact, this 79 cents that let me get that right. The 79 cents that I earn in end of year 3 is going to then grow at 1.5% forever. So to capture that, I need to change this formula here. I'm going to say that I'm going to receive 79.79 billion at the end of year 3. I'm going to do a growth perpetuity. Remember to calculate a growth perpetuity? Divide by the discount rate minus the perpetual growth rate, which we'll assume is 1%. That is now the present value of a cash flow that starts in year 79 and continues infinitely, growing at 1%. However, when you apply the growth perpetuity formula, it always gives you the value in the period before. So this is actually the value of that series in year 2. So I need to discount that back for 2 years. So that now is my NPV of this banking investment. Let's talk about firm value. Now, WACC can also be used to value the overall cash flows of a firm. And when you do that, when you take a value of all the free cash flows of a firm's existing business, that present value is called the enterprise value. It's the value of the entire firm. In other words, the value of all the profits and cash flows that are generated by the firm's assets. Now you could then subtract out the value of debt, and that will be called the value of equity in the firm. Now the next slides are going to talk about these terms, which are enterprise value and equity value, and also some other terms that come up: book value, market value, and fundamental analysis. So let's talk about book value, market value, and fundamental value. Book value is really looking what was the value of something. Comes from the balance sheet, right? Looking at the rear view mirror, what was the cost basis of an item? So for equity, that would be what was the cost of the equity when it was issued. If it's the debt, what is the cost of the debt and cash when it was issued? If we know the equity, we know the net debt. We can take the net debt plus the equity. We can call that the total enterprise value of the firm. Right? Since assets equal liabilities plus equity, this will be the total value of the firm. Now market value is different than book value. It's not the historical value of it. It is what is it selling for in markets. Now for stock, that's pretty easy. I can just take the share price of the stock times the current market price of the stock. For Walmart, that would be on the NYSE, and get the total selling price of the stock. Now it's impossible to really get the market price of bonds, and you just hope that the book value is close enough, so we call that a proxy. So we can take the net debt plus the market value of the stock, and we can call that the market value of the enterprise. However, fundamental value is another valuation. Fundamental value isn't what is it trading for or what is it selling for in markets. The question it asks is what should its value be? What's it worth? Which could be different than the market price, which then creates opportunities. How we're going to do that is we're going to estimate the total free cash flows of the firm going out forever. We'll take the present value of Walmart's, what we're going to get to in a minute, Walmart's total cash flows forever based on some assumptions. That would be the total value of the firm, the enterprise value. We'll then subtract out the value of debt, and that's what the stock is worth. the equity. And if we divide by number of shares, we can actually get a share price. So let's do that for Walmart. Let's I want to got some balance sheet items. Walmart has $81 billion of equity in the balance sheet, which is $26. If I divide by the number of shares outstanding, that's $26 per share. That's called the book value per share. If I look at the debt in the balance sheet, they have $50 billion of debt and $9 billion of cash, which is a net debt position of $41 billion. If I take net debt plus equity, that gives me $122 billion, and that's its book value of enterprise value. Now, if I look at market values of Walmart, their stock on this particular day was trading for $72 a share, 3 billion shares outstanding. That's $223 billion of market cap, the market value of all their stock. If I then add the value of their debt, that would give me a market value of their enterprise of $263 billion. Or I can take 263 minus 41 and I can get a market cap of 223. However, what is the value of the total firm of Walmart based on the cash flows that are being estimated, and the cash flows that you can estimate and the discount rate or the riskiness you think of the stock? We could take the present value of all expected free cash flows of the firm. That would give us a fundamental value, what you think it's worth. And maybe if you think it's worth more, maybe you should consider a takeover of Walmart, if anyone had enough money. And if I knew the total value of the firm, if I then just subtract out the value of debt, that could tell me what I think is the fundamental value of the stock. So that's what we're going to do. So we're going to estimate WACC, use that to estimate free cash flows to the firm using our formula. Take the present value of all future free cash flows, that'll be my enterprise value. Subtract off net debt, that'll give me equity value, and I'll divide by number of shares, and that'll give me the stock price, fundamental stock price. So let's grab some financial data. So I grabbed this already, and here's the information I got on Walmart. We'll just say we'll just pretend this period just ended. Don't worry about the dates. So let's say that in the most recent period that just ended, they had $14 billion of net income. This is the last few years of data. Some CapEx from the statement of cash flow. Now to get the working capital, I got net receivables, inventory, other assets, or other current assets, accounts payable, other current liabilities. We can then add up the current assets and subtract the current liabilities. And that will give us the non-cash working capital balances. And then I have cash and cash equivalents from the balance sheet, total debt, long-term and short-term portions of total debt. I just need 1 year's data. There's my net debt position. Here's interest from the income statement. I'll need to add that back. And here's my depreciation expense from the statement of cash flow. So what I'm going to do is calculate the free cash flows historically for Walmart. So they had net income of $14.6 billion. I'm going to add back depreciation. Add back interest. Take the interest expense times 1 minus the tax rate. I got their tax rate of 30% from their income statement. So if I add net income, again, net income already has interest subtracted, so I'm just adding it back with the tax effect. I have earnings before interest and after tax of $16.4 billion. Then I'm going to add back depreciation to get to cash flows. I'm going to subtract changes in working capital. So I'll subtract that change in working capital and subtract out CapEx. And if I sum up the earnings before interest and after tax and those three adjustments, I got $17,087,000. as free cash flows, and we'll assume that period just ended. And then I'm going to assume that cash flows grow at 1.5% forever, just a simplifying assumption for now. So we'll take 17 billion times 1 plus my perpetual growth rate. Now, a note on perpetual growth rates. Perpetual growth rates can never be higher than the expected nominal growth of the U.S. economy. If you assume a growth rate greater than the economy, and then what you're assuming forever, you're assuming that eventually this firm becomes larger than the economy. So you can see why you can never assume that. Now, the overall growth rate of the economy is generally assumed to be about 2 to 3% nominal terms. And just round numbers I'll give you. So maybe there's 1% inflation, so the economy grows due to inflation. Again, we're looking at nominal growth. You have 1% population growth, so the economy is going to grow at population growth. And there's got some productivity growth, say 1% productivity growth a year. So you would think that an economy should grow at about 3% per year for a relatively mature country. So my forecast of cash flows next year is $17 billion. Again, we're just assuming this one's already paid. So what's the enterprise value of Walmart? Well, if you assume that cash flow grows forever, and I use a WACC that we estimated before of 6.67%, we can get an enterprise value of $335 billion. So in other words, if I owned all of Walmart, I bought it all up and retired all the debt, I could generate cash flows of $17 billion a year, and it would grow by 1.5%. That has a present value of $335 billion. That's what I should be willing to take over Walmart. Now, if I take that $335 billion enterprise value, I subtract off the net debt. If I just wanted to buy the equity of Walmart, that should be worth $294 billion. Now there's 3 billion shares of Walmart outstanding. If I take my equity value of $294 billion divided by 3 billion shares, I should be willing to pay $94 for Walmart. They're currently selling for $72, so what that says is I can buy Walmart cheap and hope the rest of the world gets as smart as I am and realize that it's worth $94. Or I'll just buy it for that $72 and earn all those cash flows and earn a positive NPV for a stock investment. So this is how we can use free cash flows to the firm and WACC to value enterprise value, back out net debt to get to equity value, divide by number of shares, and now you've valued Walmart. However, this model I've given you only works on a certain class of firms. And those are a class of firms which are already at a growth rate lower than the growth of the economy and are supposed to stay there forever. What if you just read some new news? All right, and you read some new news that Walmart might grow at 6% next year because of maybe their strategy with China growth or something like that. So, or let's just say 5%. We'll be a little more conservative. What if we think it's going to grow 5% next year, but then in a few years it'll get down to 1.5%? Well, we can value the firm by adding a little something called a growth ramp. So I have it down here all set up. Let's just assume, just for simplicity's sake, we're going to change these growth rates in a minute. Let's just assume that growth is going to be 1.5% forever, at least for the next 5 years, and then forever. Let me just revalue Walmart in 5 years versus just in 1 year. And I'm going to show you you're going to get the same value. So the free cash flows start out at $17 billion. Then it's going to grow, and let's just use 1 plus these 4 growth rates. I don't need to anchor those. So now let's just pretend it grows at 1.5% forever, just like I said it would. So the cash flows get up to 18,408. And then let's take the present value of cash flows. 1 plus WACC. I'm going to anchor WACC to the period. So I calculate the present value of the next 5 years, and then let's do that growth perpetuity again. That if I take that last cash flow and I assume that one grows at 1.5% forever, I can divide by WACC minus the perpetual growth rate. We'll make this the perpetual growth rate. Now that's going to give me the present value in year 4. So I'm then going to discount it one more year. Discount it back 4 years. So that's 274 billion there. And if I sum that up, I get 335 billion, 351, 782. Now that's the exact value as I got here, because it's using the same assumption. It's going to grow at 1.5% per year, and then forever. And then I could subtract out. Let me just take a negative net debt, and then I could take my enterprise value, take out the net debt, and divide that by the number of shares, and I'm back to 94.21 or 94.25. So nothing's changed here, but this is called a growth ramp, and the reason why you do that is, what if you had news that you think they're going to grow at, say, 5% next year? And then maybe growth will slow up in the second year, and maybe goes to 3, and then maybe 2. And you can do as many iterations as you want. And what this is doing is the growth ramp. And now the number of years depends on how long you believe it'll take to get to perpetual growth. So if you think it's going to grow at 5% next year, and then 3, then 2, then 1.5 forever, you can probably get away with a 3 or 4 year growth ramp. However, if you're valuing a company that's currently growing at, say, 20% a year, it's going to take a long time, presumably, for them to start growing at a growth rate less than the economy. So I might have a 10-year or 20-year growth ramp for a firm that's growing at 20 or 30%. So it's all about how long will it take for growth to get down to a sustainable perpetual level. And that determines how long the growth ramp is. So that's how you handle firms that are growing faster than the economy today. So I did an example here of 543, and I got to 101.71. And I got a valuation of 101.71. So 543, I could just do that. 543, there's my 101.71. So now it's worth 101 versus a constant growth immediately for 94. So that's how you use free cash flows of the firm, WACC to value the entire enterprise value of the firm, then subtract out the value of debt to get the value of equity. Now, when I did a constant growth, again, I just got to $94. If I do that, I can fill out the rest of my schedule here. Remember, we already calculated the book value and market value of Walmart's equity and enterprise value. Now we can calculate the fundamental value of the enterprise, which is $335 billion. That's the present value of cash flows. If I then subtract out the value of debt, that gave me a $294 billion equity value. And if I divide that by the number of shares, that's $94 per share. So on the books, the shares are worth $26, but that means nothing. That's just historical accounting of them. In the markets, they're selling for $72 a share. That's the market price. Based on your estimation, you believe they're 94. Therefore, you think this stock is a buy. But you can do some sensitivity around that. And it looks like, based on some assumptions on different WACCs and different perpetual growth rates, you can come up with values as low as $56 a share, which would be a sell, and as high as $219. And if you think these are reasonable ranges, this looks like a pretty good stock. It's $72 from now, and maybe I lose 20 bucks if it falls to this range, but maybe I make $150 if it goes up to this range. That's one way of thinking about investing. You don't really know what the exact estimate is. I have no faith in any of these numbers, but if I think that I have faith in the range of these numbers, that looks like I have more upside than downside on this stock. And we'll just do one last thing, and that is looking at a pro forma financial planning model. and I'm just going to grab that model and look at it in Excel. So I wanted to show you this. It's a little bit different way of forecasting. This is an interesting model. This is from the textbook. And it's arranged at an interesting way of showing a model, and that is at the top of a model, specify what are value drivers. What are the assumptions that drive the value of this enterprise or project or whatever you want to do? And then I have some assumptions here on balance sheet financing of a project. So this is looking at a firm in total. It's going to have sales growth of 10%. Current assets divided by sales is going to be 15%. Current liabilities divided by sales will be 8%. Net fixed assets divided by sales will be 7%, and so on. So these are our forecast drivers or value drivers. These are our actual values from the prior year, sometimes called actuals. And here's a forecast. So here's how you can use a value driver model to forecast a financial statement, all the way through the balance sheet and to free cash flow statement. So you can always, and I'm going to do this in a particular order, and you can see why, because we're going to actually deal with the balance sheet, debt, and equity values, which gets pretty complicated. So I'm going to take sales times the growth rate of sales. So 10 billion times 1 plus 10% growth, I'll get 11 billion sales. Now my assumption on cost of goods sold is going to be 50% of sales price. So I'll take 50% of that as cost of goods sold. Now I'm going to have to jump down because here I have an estimate. I need depreciation expense. Well, depreciation expense depends on CapEx and depreciation. So I'm going to go from sales and cost of goods sold down to net fixed assets. So we're going to say net fixed assets is an assumption that our net fixed assets are 77% of sales. That's the level of fixed assets we need to generate the sales. I'll then calculate, well, here you can see I just copied this down. Fixed assets at cost is the difference here between net fixed assets and accumulated depreciation. So the cost of these items, cost of these capital expenditures must have been 10 billion because their net value is 7 billion, so we must have subtracted accumulated depreciation so far of 3 billion. So I'll just copy that formula over. So now we know that the depreciation, accumulated depreciation, must be the difference between these two numbers. So I'm going to calculate the prior depreciation based on the average fixed cost and the depreciation assumption we made. We're going to assume that we're going to depreciate 10% of our fixed assets a year. Therefore, we now can get depreciation expense. Now, the annual year's depreciation will be the difference between these two numbers, 3 billion and 4.1 billion. That's going to give us our $1 billion in depreciation expense. So you can see how this process gets pretty complicated. Just working down the income statement, I get stuck at depreciation expense because depreciation expense depends on what fixed assets I bought and how I'm going to depreciate them. So I make an assumption of what my net fixed assets have to be, what my depreciation percent of net fixed assets will be, and then I can back into this year's depreciation expense. So back up to the top, I now have my depreciation. Now I need interest on debt. Well, interest on debt is going to be average debt balance times the interest rate on debt. That's going to be one of my value drivers. But let's jump down. To get to debt, I need to do a few things first. Let's look at current assets. I'm going to calculate current assets are assumed to be a percent of sales. So it looks like I'm going to take 15% of sales are going to be in current assets. And then I'm going to figure out how much cash I have. Now I'm going to use one particular model here. This is a model for modeling the balance sheet where cash is a plug. So it's a common method for getting the balance sheet to balance. That eventually I'm going to forecast debt and equity, all the other current assets and current liabilities. But in order for the balance sheet to balance, in other words, have the liabilities and equity equal to assets, I'm going to have to create a plug, and that plug is cash. Cash is equal to the difference between total liabilities and equity, total L&E, minus all fixed assets and current assets excluding cash. So what this makes sure, this little plug makes sure that the total assets equal total liabilities. So that's what I was able to do. So when I calculate the average interest earned on cash, I now have a cash amount. Use the average cash balance multiplied times the interest on cash, and I have interest investment earnings. In other words, interest earned on cash. That gives me total profits, taxes, profits after taxes. I'm going to use a dividend rate of 40%. Let's assume the company pays out 40% of its earnings as dividends. That gives me additions to retained earnings of 40% of profits. I'm sorry, 60% of profits. So what is not paid out as a dividend is available to pay as goes to retained earnings. This number then goes down here to retained earnings, additions to retained earnings. There's my retained earnings. So it's the prior year balance plus additions retained earnings. So it looks like we have the income statement almost done, but let's talk about a few things I had to do with the debt and equity. And that is, namely, we had to make assumptions about how debt and equity are going to change. And the assumptions are here. There's going to be zero change in equity. So we have equity as constant. But what I'm going to assume is the firm wants to pay down $800,000 of its debt. So I have the prior year value plus the change in debt. So this gets to the area that you can actually build in your strategy as far as capital structure. This firm would like to pay down debt and keep equity constant, which is going to reduce their D to E ratio, which may make them more credit worthy, and maybe they can get a better deal on their bonds when they issue them next time. So by modeling the debt and stock based on their policy of issuing or reducing debt or equity, and then making cash as a plug, I can get my balance sheet to balance. Now, I'm going to make a little note here that normally I would get a circular reference if I did something like this, because think about what I'm doing. If my profits go up, my cash is going to go up, right? Because my profits go up, my retained earnings are going to go up. Therefore, my cash balance is going to go up, right? Because this is going to be a plug. So if I have to get that to balance, my cash is going to go up. When my cash goes up, I'm going to earn more interest on my cash, right? That's this line here, which is then going to make profits go up, which will then make retained earnings go up. And see what you see, you have a circular reference here. Now to get Excel to handle a circular reference, find a value of these assumptions consistent, is I'm going to go to File, Options, Formulas, and I'm going to allow iterative calculation, which is kind of like using a solver. It's going to find those values of cash and debt balance that satisfies the model so that my balance sheet balances. So this is an example of a very complex model in which I have value drivers for all of my current assets, current liabilities, expenses, interest rates on debt, interest rates on cash balances, and so on. Makes assumptions on debt and stock, create cash as a plug, and I'm able to forecast an entire set of financial statements. And if I need to forecast free cash flows of the firm, I can just take those items, profits, depreciation, changes in working capital, minus CapEx, add back interest, and I can get to free cash flows of the firm. Now I can do this for a project, or I can do this for the total firm, and I can extend this to many years and take the present value as the value of the company. So I just want to expose you to a value driver model, or a pro forma financial model. A couple notes on capital structure, since we're talking about, in this case, reducing debt, keeping equity constant or stock constant. The mix of debt and equity in a firm is called capital structure. And the advantage, let's talk about the advantages of using debt versus equity to finance investments. The advantages of debt versus using equity to finance a project is debt creates a tax shield. Interest expense is tax deductible. Dividend payments are not. Therefore, there's an advantage anytime you use debt to finance a project because you create a tax shield. The other advantage is no dilution of ownership. So if you issue more stock to finance a new project, the number of shares go up, so all the current owners have a lower fractional ownership. Now the disadvantage for debt financing for equity holders is it creates fixed expenses. And anytime you have fixed expenses, you're going to have a higher probability of going bankrupt or having some kind of financial distress. Also, if you have more debt, all right, think about the exercise we did at the beginning of this exercise. Your DE ratio is going to go up, which is going to cause your beta to go up, right? Your levered beta is going to go up, which is going to cause your cost of equity to go up, which is going to cause your WACC to go up, and then people are going to value your firm at a lower value. So those capture some of the advantages and disadvantages of using debt in financing. Which leads to another question is, what do firms do when they have excess cash? You see companies like Walmart or Apple, and they have lots of extra cash. So the question is, what do you do with cash? So here are some points that you can do. You can use it to pay down debt. Now, firms like Apple don't have a lot of debt, so they can't really do that. But the advantages of paying down debt, well, you can look at the disadvantages of debt and you get rid of those. Or you can use cash to make more purchases, higher CapEx, or use it for R&D to create future growth. So you can either use it to pay down debt, or use it to finance more investments, launch more products, or you can pay out a dividend. If you pay out a dividend, it's good for the shareholder. They get to cash right away. And if you miss a dividend, that's a bad signal to investors. So you never want to miss a dividend. So that's good to pay it out. But a disadvantage of paying out cash as a dividend is dividend income is taxed at a higher rate than capital gains for most investors. Therefore, you're better off not giving them a dividend and trying to give them money a different way. A way of getting them money a different way is doing a stock buyback. A firm can do a stock buyback where they can choose to buy back some shares. It's an alternative to a dividend. And the benefit is a shareholder could exchange for shares, sell back their shares, in that case get a capital gain versus a dividend income. Or the firm can just hold cash. If a firm holds cash, it just gains interest on the cash. It creates kind of a rainy day fund if things go wrong. However, that cash could have been used to do all these other things above. So I just wanted to have a little discussion of capital structure, the advantages and disadvantages of debt, and what do firms do with all that extra cash when things are going well. So on this topic, we talked about computing NPV using free cash flows of the firm and WACC. We estimated fundamental enterprise value and equity value using free cash flows of the firm and WACC. And we talked about using a value driver model.